I'd like to thank everybody for joining me today. Today, I want to talk about premium financing. Premium financing is a great tool, it's a great strategy, and it's a great strategy if it fits what the client's trying to accomplish. So, if we look at this, what is premium financing? Let's start with a good example. Let's assume you have $1 million in the bank and you want to buy $1 million home. How are you going to pay for that? Are you going to pay cash? So you can write a check, no interest. $1 million of your capital is now tied up in the house. Or are you going to make a small down payment and finance that house with a mortgage? Well, most people are going to finance the house with the mortgage. Why? They don't want to tie up their cash into their home, and they can take that home and that cash and live in the home and still have the cash available for other things. So why do people always pay cash for their life insurance? And is there another option that may be a good fit? So what is premium financing? Premium financing is one where we go to a third party lender that pays the premium on large life insurance policies. So you pay the interest and keep your own capital invested in what you're using it for. So think about this: the lender is going to fund the premium, the policy is going to go to work, have the death benefit, building cash value inside the policy, everything that we would design that life insurance policy to do. And then three, at some point in time, we're going to have to pay off that loan. We want to exit the financing. Just like if you had a house, you're going to pay that mortgage off at some point in time. We're going to do that with premium financing, but it's leverage the bank dollars instead of liquidating your own capital and using it to pay the premiums. So there's three ways that you can fund the premium on a policy. Number one, you can use your own money. You're going to pay the premiums directly from your personal savings or cash, income. And so that's how the majority of people will pay the premiums on their life insurance policy. Or two, you can use your business to pay those premiums. Either that's a business policy that's owned and controlled by the business, it's for employees of the business, or you can take a loan from the business and have that paying the premiums on your personal life insurance. Or three, we can borrow and use other people's money. So there's, these three ways to fund that premium of the policy, and they're all valid depending on what we're trying to accomplish. So now, why would we use other people's money? Why would we go to the bank to use the bank's money to pay for life insurance premium? Well, the big answer is it's leverage. If we have in our business, we're generating, let's just say, a 10% return on our investments, or we've got money invested in the stock market that's getting us double-digit returns. Well, do we want to pull that money out and lose that growth in our assets and our income? And if we're getting a 10, 12, 20% return, whatever it is on those assets, and we can go borrow from the bank at, say, 5 to 7%, we've created leverage by using that other people's money, the bank's money, while we keep our money growing at a much faster rate. So leverage is the first one. Other is not using our out-of-pocket savings. We're keeping that rainy day fund there. So we can, we're using less of our own money. We're keeping that on hand just in case, so that our savings and all that is in place. And finally, we've got if we're taking money out to pay those premiums, we're going to have a disruption in our cash flow. So to avoid disrupting the cash flow that we need personally or in our business, we're using that money from the bank so that we can keep our cash flow doing what we've got it doing now. And liquidity comes into the next part. If we're using up all of our assets, we're going to have to reduce our liquidity. We're going to have to sell off assets. And there again, that might take away from future growth in our personal or business investments. For those that have larger estates, premium financing is a great way to be more efficient with our gift tax. Instead of using our gift tax exemptions to fund those large premiums, now we can put a smaller amount in on a gift tax, against our gift tax, and we're using the bank to finance that premium, not subject to the gift tax. So it creates efficiency in our estate and gift tax planning. And finally, it's going to be a smaller impact on our working assets. There again, do we want to keep our assets growing, working, building in our business or in our investment portfolio, and taking care of what we need while we have the bank money being financed so that we can make sure we have our life insurance that we need in place, and we're not sacrificing today's assets to fund tomorrow's life insurance need. So it's a great way to leverage and use that other people's money to keep our assets doing what they're doing now. So any type of loan, and premium financing is no different. The loan has to be repaid. And we want to make sure we look at this ahead of time to make sure we know and have a clear exit strategy. Well, number one, we can, if we're building up cash value inside that life insurance policy, we can use that policy's cash value at some point in time to repay some or all of the loan. So if that cash value is growing and we can pull some or all of that cash value out, pay down the loan or pay all of the loan off, that just reduces the amount of commitment that we have to, repay that loan, and maybe we get a better leverage play at that point. So it's always good to look at cash value as one. Number two, we can use other assets. So if we've let our business grow, we've let our investments grow, now we can take some of that money and use that to pay off some or all of the loan as well. And finally, the third thing, and this will always be designed into a premium finance case, the death benefit will always pay off whatever loan is remaining first, and then the net proceeds after the loan will be distributed out to whoever the beneficiary of that policy is. So we want to make sure as we go into this, we know how the loan is going to get repaid before we ever sign up for the premium financing. Well, like any strategy, we want to understand the risks. What are the risks of borrowing money, using other people's money to fund our premium financing? Well, one is interest rate risk. Interest rates on most premium finance cases are going to be variable. Now, you can get a fixed rate, it's going to cost you more, and there again might remove that interest rate risk, but loan rates tend to rise. We're in an environment where rates are going to go up and down, so we just want to account for that, knowing that's a risk. And all of these premium finance cases are fully collateralized. Number one, they'll look at the cash surrender value. If there's a gap in the collateral need, then you're going to have to post collateral or potentially a letter of credit. So there's a potential that if the cash value goes down as the debt is increasing, we may have to put in more collateral, especially in the early years. As soon as we get enough legs growing and get that cash value growing, typically the cash value will take over and reduce the risk of putting in more collateral. Of course, with every life insurance policy, there's risk in policy performance. If the policy's not performing as well as we had anticipated, then we might have to put more money into the policy, more money into collateral, or redo the loan to take care of that lack of policy performance. And finally, there's renewal and exit terms. Loans are typically, can renew. We see a lot of 5-year loans, and we see some loans that are guaranteed for the life of the policy. So whatever it is, we want to make sure we understand that, all of that up front, and make sure it works. Is premium financing right for you? It's not for everybody. It's typically high net worth and high income. Strong balance sheet is a key. An ongoing need for the life insurance. We're trying to solve a goal, whether it's estate liquidity or wealth transfer or replacement of income. All of those things we just want to know, is this policy good for you? And finally, are you comfortable with leverage? Do you understand leverage and that it can be a great tool as things are going up, but it's also a tool that if things are going bad, it's going to, be a much bigger problem for us. So we want to make sure the strategy works and fits for every client that does it. Finally, when we build these policies and these plans, we want to make sure we understand every step. And the big steps are making sure that we do an ongoing monitor of the performance of the policy and the collateral needs, and that we're ready to execute and exit the exit strategy when the time comes. So great strategy for those that need it, great opportunity for everybody. It's a great tool. We just want to understand it. And for the right client, it's a great fit. I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.